I used to think the only way to get cash from my stock portfolio was to sell shares and pay the tax bill. Then I discovered something that completely changed how I think about accessing my wealth. A way the ultra-wealthy have been using for decades to get cash from their portfolios without triggering a single dollar in capital gains taxes. Today, I'm breaking down exactly how this works, but there's one critical risk you absolutely need to understand before you even think about trying this. Miss this part, and you could lose everything you've built. Here's what happened. I'd been investing for years, building a solid portfolio of dividend stocks, watching my account grow steadily. Then, life threw me a curveball, and I needed a decent chunk of cash for a down payment on an investment property. I had the money in my portfolio, so I figured I'd just sell some shares and move on. Then I did the math on the tax bill. The federal capital gains tax alone would have been 15% of my profits, and that's before adding state taxes on top. I'm talking thousands of dollars, gone forever, just for accessing my own money. The shares I'd sell would be gone too, along with all their future growth and dividend income. It felt like being punished for making good investment decisions. That's when I started digging into how the truly wealthy handle this. The billionaires you read about aren't constantly selling their core holdings to fund their lifestyles. They're using a completely different playbook. And once I understood it, everything changed. The strategy goes by a few names, but the most common one is, admittedly, a bit dark. It's called buy, borrow, die. Sounds intense, but stick with me because the mechanics are actually straightforward, and this could save you a fortune in taxes over your lifetime. Think about how a homeowner uses a home equity line of credit. The bank gives them access to cash based on the value of their house. They can draw from it, they pay interest, but the house itself stays theirs. They haven't sold anything. This is the exact same principle, just applied to your investment portfolio instead of real estate. The tool that makes this possible is called a securities-backed line of credit, or SBLOC for short. Some people also call it a margin loan. It's essentially a revolving line of credit from your brokerage, secured by the stocks and other assets in your account. Here's the game-changing part. When you take out a loan, the IRS doesn't see it as income. You're not selling anything. You're not realizing a capital gain. You're simply borrowing against an asset you already own. No sale means no taxable event, which means no capital gains tax. This is the core of the borrow phase, and it's what turns your portfolio from a locked box into a functional source of cash. Let me walk you through how this actually works in practice. The strategy breaks down into 3 distinct phases, and understanding each one is crucial. Phase 1 is buy, and this is all about building your foundation. You need to own appreciating assets for this to work. This isn't some shortcut to quick money. It's a long-term wealth strategy. The buy phase means patiently building a portfolio of quality investments you plan to hold for years or even decades. For me, that's a diversified mix of dividend-paying stocks from established companies. There's a reason I focus on dividend stocks specifically. First, they provide steady income. Second, and this is key, that dividend income can be used to pay the interest on the loan you're about to take. You're essentially having your assets pay for their own loan. The goal is to build a solid base that grows in value over time. Phase 2 is where the magic happens. This is the borrow phase. Once you have a substantial portfolio in a margin-enabled brokerage account, you can take out a loan against its value. According to data from major brokerages like Fidelity and Charles Schwab, most will let you borrow between 50 and 70% of the value of your eligible securities, though being conservative is important for reasons I'll explain in a minute. Let's use real numbers. Imagine you've got a $200,000 portfolio and you need $30,000 for a home renovation project. You've got 2 options here. Option A is the old way. You sell shares to get the $30,000. Let's say that $30,000 represents pure profit, a capital gain. Depending on your income bracket, you could easily pay 15 or even 20% in federal capital gains tax, and that's before state taxes. At just 15%, That's $4,500 in taxes, gone forever. Plus, those shares you sold are gone too, along with all their future growth and dividends. Option B is using your portfolio as collateral. Instead of selling, you take a $30,000 loan against your $200,000 portfolio. Because a loan isn't income under IRS rules, you pay zero capital gains tax. That $4,500 stays working for you. Your entire $200,000 portfolio remains invested, continuing to grow and generate dividends. You will pay interest on that loan, but current rates at competitive brokers are surprisingly reasonable. According to recent data from early 2026, rates at a broker like Interactive Brokers or through programs like Schwab's Pledged Asset Line can range from around 5 to 7%, depending on the loan size and your relationship with the firm. Let's say your rate is 6%. Your annual interest on that $30,000 loan would be $1,800. Compare those two scenarios. A one-time, irreversible tax hit of $4,500 versus paying $1,800 a year in interest while your entire portfolio keeps working for you. And here's another advantage. That interest you're paying can often be deducted against your net investment income if you itemize your deductions and use the loan for investment purposes, which can lower your overall tax bill even further. Phase 3 is what makes this strategy truly powerful for building generational wealth, and it centers on something called the step-up in basis. This is where the die part of buy, borrow, die comes in, and yes, it's a bit morbid, but the tax implications are massive. Here's how it works according to current IRS rules. When you pass away, the people who inherit your stock portfolio don't inherit your original cost basis. Instead, the cost basis of those assets is stepped up to their market value as of your date of death. This is a provision in the tax code that's been around for decades, and it's completely legal. Let's go back to our example. Say your $200,000 portfolio grows to $1 million over your lifetime. That's an $800,000 unrealized capital gain sitting there. If you sold it all while you were alive, you'd owe a massive tax bill on that gain. But using the buy, borrow, die strategy, you just hold on and keep borrowing against it as needed. When your heirs inherit that $1 million portfolio, the IRS essentially treats it as if they bought it for $1 million on that day. According to IRS publications on inherited property, they can then sell the entire portfolio and pay almost zero capital gains tax. The entire $800,000 gain that accumulated during your lifetime is legally eliminated from a tax perspective. Any outstanding loans are simply paid off from the estate's assets, and the rest passes on to your heirs. This is how wealthy families transfer massive amounts of wealth across generations while legally avoiding enormous tax bills. It's not a loophole, it's literally how the tax code is written. Now here's the part where I need you to really pay attention, because this is where people get themselves into serious trouble. This strategy is not a free lunch. It involves leverage, and leverage is a double-edged sword that can destroy your portfolio if you're not careful. The main risk is something called a margin call. A margin call is a demand from your broker to add more equity to your account, and it happens when your portfolio value drops significantly and the loan you've taken out becomes too high a percentage of your account's current value. Your broker gets nervous that their loan isn't safely covered anymore. Let's use our earlier example. You've got a $200,000 portfolio and a $30,000 margin loan. That's 15% borrowed, which seems conservative. But then, a nasty bear market hits, and your portfolio plummets 40% to $120,000. Your broker has what's called a maintenance margin requirement. Let's say it's 30%. If your equity falls below their threshold, you get the dreaded margin call. Here's where it gets brutal. You'll be forced to either deposit significant amounts of cash immediately, usually within 2 to 3 business days, or the broker will force sell your stocks to pay down the loan. And this is the devastating part. They're forcing you to sell at the absolute worst possible time, when the market is at a low. According to brokerage agreements, they can sell whatever securities they want, without your permission, without even notifying you first, to cover that call. This locks in your losses permanently and can cripple your portfolio's ability to recover. I've seen this happen to people, and it's ugly. They thought they were being smart, they borrowed too much, the market dropped, and they got wiped out. This is why you have to be incredibly conservative with how much you borrow. I personally would never borrow anywhere near the maximum limit. Borrowing a small, manageable percentage, say 10 to 20% of your portfolio value, gives you a huge buffer to withstand normal market swings. There's also interest rate risk to consider. These are variable rate loans in most cases, tied to rates like SOFR. If interest rates spike significantly, your borrowing costs could increase, making the loan more expensive to carry. So who can actually do this safely? There's this misconception that it's only for billionaires. While they certainly use it on a massive scale, the mechanics are accessible to regular investors. You can typically open a margin account with just a few $1,000s at most brokerages. However, to do this safely and effectively, you need a significant portfolio. According to lending requirements from firms like Fidelity and Schwab, many formal SBLOC programs require a minimum portfolio of $100,000 or more just to qualify. Borrowing against a $10,000 portfolio is incredibly risky because a small market dip could trigger a margin call and force liquidation. This strategy becomes much safer as your portfolio grows into the six figures and beyond. A larger portfolio can absorb market fluctuations without breaching those critical margin requirements. This isn't about your annual income, it's about the assets you've already built. It's for the disciplined, long-term investor who has patiently constructed a foundation and now wants to use it more intelligently. Let me be crystal clear about something. The information I've shared today is for educational purposes only and should not be considered financial advice. Every investor's situation is different, and you should consult with a qualified financial advisor and tax professional before implementing any strategy involving leverage or loans. Market conditions can change, tax laws can change, and what works in one scenario might not work in yours. This is just one strategy that fundamentally changed how I think about building and accessing wealth. If you're serious about learning more smart ways to manage your money and understand how the tax code actually works, hit that subscribe button so you don't miss what's coming next. It's time to stop just playing the game and start understanding the rules the wealthy have been using all along. I stopped thinking of my stocks as just numbers on a screen and started seeing them as functional tools I can use to access cash for my life today without sacrificing growth for tomorrow. By borrowing conservatively against my portfolio, I avoid the wealth-destroying hit from capital gains taxes and keep my investments compounding for the long term. But this demands respect. The risk of a margin call is real and can be catastrophic if you get greedy or careless. When used responsibly and conservatively, though, with proper understanding of the risks and appropriate portfolio size, this is one of the most powerful financial tools an investor can have. It's about taking control, understanding your options, and making your money work for you in more ways than one.